Welcome to Breaking News to Trading Moves. Imagine paying 30% more for a plane ticket, and the airline still expects you to pay for your own soda.
Right, and the flights are completely packed. The upgrades are totally sold out.
Exactly. Today, we're looking at a wild contradiction in the economy. The headline sweeping through financial media right now is that corporate America is still making serious money.
Yeah, and earnings growth is broadening well beyond just big tech and Wall Street. That is the core narrative we're tracking.
I mean, we're talking about an environment with war risks, higher oil prices, persistent inflation pressure, and incredibly weak consumer sentiment.
Right. But despite all those headwinds, many major U.S. companies are incredibly resilient. They're growing revenue, protecting their margins, and successfully passing higher costs directly onto their customers.
So today's mission is to simply look at this headline and identify the specific winners and losers across various sectors for you. We're going to separate the companies that are actually benefiting in this environment from the ones being left completely behind.
Yeah, there's a very clear line drawn in the sand right now.
To really visualize what is happening out there, I want to introduce the concept of a K-shaped economy to you, the listener. Think of it like two different people spending a Saturday at a large amusement park.
Okay, lay out the amusement park analogy for us.
Well, on one side, you have a person who is freely buying the VIP Fast Pass to skip all the lines, right? They are sitting down for a full-service meal at the premium restaurant inside the park, buying the souvenir photos, and not really worrying about the cost.
Yeah, they're just enjoying the experience.
Exactly. But on the exact same day, in the exact same park, you have someone who packed their own lunch in a cooler in the car.
Right.
They are skipping the midway games entirely, solely because the baseline admission prices went up so much that they have literally zero budget left for anything else.
So they're in the same environment, but having two completely different financial experiences.
Exactly.
And that analogy perfectly illustrates the underlying data. Large companies are navigating a highly divided economy right now. Wealthier consumers are doing better than average households.
So the top arm of that K-shape represents the VIP Fast Pass buyers.
Right, those affluent households who are unfazed by higher admission prices. The bottom arm represents the households packing their own lunch, feeling the relentless squeeze of inflation on their daily budgets.
And companies cater to one or the other.
Yes, and that specific positioning dictates their current earnings strength.
Well, if we apply that amusement park analogy directly to how people are currently traveling, we can move from the broad economic picture right into the airline sector.
Oh, absolutely. The person buying the VIP pass is the exact same person getting on a plane right now, which creates a very stark divide in travel.
So who are the winners here?
The clear winners right now are the full-service airlines. These legacy carriers are directly benefiting from strong business travel, premium seating, and robust international demand.
Because the VIPs are still flying and, they want the extra legroom. We are talking about United Airlines, Delta Airlines, and American Airlines. That is UAL, DAL, and AAL on the board.
Exactly. Wealthy consumers and corporate travelers just keep spending, and because of that sustained demand, airlines with strong premium cabins and extensive international routes possess incredible pricing power.
They can just maintain or even raise their ticket prices.
Yeah, because their target customer is just less sensitive to the cost. If a corporate account is paying for the business class seat, the exact dollar amount matters far less than the schedule and the convenience.
Let's contrast that with the losers in this specific environment, which are the lower cost and consumer-sensitive airlines.
Right.
You would expect the budget carriers to be cleaning up right now. The companies facing severe pressure here include Southwest Airlines, JetBlue Airways, and Spirit Airlines. So you are looking at LUV, JBLU, and SAEQ.
Yeah, they target the leisure traveler and the budget-conscious consumer. But they're actually getting hit much harder by a combination of higher oil prices and weaker consumer sentiment.
Wait, let me push back on that for a second. Usually when money is tight, people look for a bargain. Why aren't budget airlines winning right now?
It comes down to the mechanics of fuel costs and the exact nature of how price-sensitive travelers behave. Higher oil prices raised the baseline cost of operating a flight.
Okay, that makes sense.
For a budget airline, unit economics dictate everything. Their margins are razor thin, and they rely entirely on volume. They need that plane in the air, full to the brim, turning over multiple times a day.
So when fuel goes up, they have absolutely no choice but to try and raise fares to cover that cost.
But here's the problem. They lack the room to raise fares without immediately hurting demand.
Because their customer is the person packing a lunch in the cooler. They are already at their financial limit.
Precisely. When the budget airline raises ticket prices even a little bit to cover jet fuel, leisure travelers become highly selective. They do not trade down from a full-service airline to a budget airline.
Well, they don't.
No, instead, they pull back entirely. This is called demand destruction. They decide to stay home. They decide to drive instead of fly. The budget airlines lose volume, and because they cannot command premium pricing, their profit margins just evaporate.
Wow.
Yeah, and the legacy carriers do not have this problem because their corporate and wealthy clients will pay the fuel surcharge without blinking.
That makes perfect sense.
Mm-hmm.
The demand just vanishes. It doesn't just migrate to a cheaper option. And, if those wealthy consumers are ignoring higher airfares, they are definitely ignoring the price of a nice dinner or a luxury handbag once they land.
Oh, without a doubt. And that brings us to the retail and spending divide.
Right.
If we follow the money from that premium airline ticket, we find the next set of winners: credit cards and premium consumer spending. The K-shaped economy heavily favors companies exposed to higher income consumers.
Affluent households continue to spend heavily on travel, dining, luxury goods, and high-end experiences.
And somebody is collecting a fee on every single one of those swipes.
Exactly. Payment networks and premium card issuers benefit directly from these stronger transaction volumes. The companies seeing the upside here are American Express, Visa, and MasterCard. So you were looking at AXP, V, and MA.
Yeah, absolutely.
I offer this analogy for you to consider. Payment networks act like a toll booth on a luxury highway. They do not own the cars, they do not own the road, and they do not own the destinations.
I like that.
They just collect a small fee every time a vehicle passes through. They get paid as long as the traffic keeps flowing, and right now the luxury lane is moving incredibly fast.
That is exactly how the mechanism functions. As the total dollar amount of the transactions goes up because luxury goods and premium travel cost more due to inflation, the payment networks naturally capture more value.
Right, and they're uniquely insulated from the cost of producing physical goods.
Exactly. Visa doesn't have to worry about the cost of aluminum or supply chain delays. They just benefit from the wealthy consumer's willingness to keep swiping the card.
Okay, that clarifies the mechanics beautifully. Let's look at the other side of that coin. We have the losers in the retail space.
Yes. Retailers exposed to lower and middle-income shoppers face intense pressure as inflation, fuel prices, and borrowing costs squeeze household budgets.
So we are talking about companies like Walmart, Dollar General, Dollar Tree, and Target. That's WMT, DG, DLTR, and TGT.
Right.
These are companies that built their entire models on serving the average household, and right now the average household is completely tapped out.
It is the exact opposite of the toll booth on the luxury highway. These value retailers operate on massive volume and razor-thin margins, very similar to the budget airlines we discussed.
But they also deal with the physical friction of moving goods.
Exactly. They have to buy inventory, ship it across the ocean, store it in warehouses, and stock it on shelves. If their customer has less money to spend because gasoline and rent cost more, the retailer's revenue takes a direct hit.
Plus, they deal with physical theft and inventory loss, which eats into those margins even further when times get tough.
Yeah. And unlike the premium brands, these value retailers cannot easily pass their own higher operating costs on to their customers.
Right. Because if Dollar General raises prices too much to cover their own supply chain costs, their budget-constrained customer will just buy fewer items or switch to an even cheaper alternative.
Exactly. It is a very difficult operating environment for businesses tied to that bottom arm of the economy. They are absorbing the inflation because their customers simply cannot.
Well, while consumer spending is clearly divided, other parts of the economy are quietly humming along in the background. That brings us to our next major sector comparison: industrials versus everyday food brands.
Right, because earnings growth is spreading to areas that do not rely on the everyday consumer at all.
The winners here are industrials, materials, and Italy services.
Yes, these companies are supported by massive long-term structural needs. We are talking about energy security mandates, global infrastructure demand, commodity activity, and global supply chain investment.
These are the companies building the physical world. We are looking at Caterpillar, Deere, Halliburton, and SLB. That is CATDEHAL and SLB on the ticker.
Right.
But why are they succeeding right now when inflation is still such a pressure point? Why buy a multi-million-dollar bulldozer when borrowing money is expensive?
Because their customers are governments, massive agricultural operations, and global energy producers. These entities have to invest in infrastructure and energy security regardless of what consumer sentiment looks like.
So it bypasses the consumer completely.
Exactly. If a country needs to secure its energy grid or a mining company needs new equipment to extract copper, they buy the equipment from Caterpillar or secure the services of Halliburton.
The demand is structurally embedded into the global economy.
Plus, these contracts are often long-term and include inflation escalators. If the cost of steel goes up, Caterpillar passes that cost on to the buyer, and the buyer pays it because the project has to be completed.
That provides these companies with exceptional pricing power and resilience. But on the other hand, consumer staples and restaurant chains are feeling the pinch. These are the losers in this specific dynamic.
Yes, when financially stretched households are trying to make ends meet, everyday food brands and restaurant chains find themselves in a very tough spot.
Right. The companies navigating this pressure include Kraft Heinz, Mondelez, McDonald's, and Starbucks. So you're looking at KHC, MDLZ, MCD, and SBUX.
They must carefully balance protecting their own margins with keeping their customers loyal.
Wait, let me ask a clarifying question here just to make sure the mechanics are clear for you listening. So if a fast food chain like McDonald's tries to charge more for a burger just to cover their own rising costs for beef and labor, they risk losing that budget-conscious customer entirely right now.
Yes, that is the defining challenge for consumer staples in restaurants today. It is a constant margin versus volume struggle.
Really?
Yeah. We are talking about the elasticity of demand. If Kraft Heinz raises the price of macaroni and cheese too high, the shopper will simply switch to the generic store brand. The demand for macaroni and cheese doesn't disappear. It just migrates to a cheaper substitute.
So they hit a hard ceiling on their pricing power. There is a psychological threshold the consumer just will not cross.
Precisely. If a fast food chain pushes the price of a value meal past a certain psychological threshold, the customer will simply decide to cook at home.
Right, because these companies rely on high-frequency, everyday purchases.
And when the average household feels financially stretched, those are the exact purchases that get heavily scrutinized.
So the companies are stuck between absorbing higher input costs, which hurts their margins, or raising prices and watching their sales volume decline.
It is a precarious balancing act that the industrial materials companies simply do not have to worry about.
Let's recap what we have covered today regarding this clear divide in corporate America. The profit gap is actively widening. We have identified clear winners who can rely on premium spending and infrastructure.
Right. Full-service airlines, premium credit card networks, and heavy industrials are demonstrating resilience. They're growing their revenues because their customers are either wealthy enough to absorb price hikes or structurally obligated to keep spending.
And on the other side of the ledger, we have the losers who rely entirely on the budget-squeezed average household.
Yeah. Budget airlines, value retailers, and consumer staples are struggling to maintain their margins without destroying their sales volumes.
The K-shaped economy is dictating exactly which sectors can pass costs on to consumers and which sectors must absorb the pain themselves. As we wrap up this analysis, is there a final thought we should keep in mind moving forward?
Consider this long-term dynamic. If resilient companies are currently successfully passing costs on to customers to protect their margins, what happens to long-term customer loyalty when those higher prices become the permanent new normal? Yeah, will the premium consumer eventually find their own breaking point? Or will the divide in corporate earnings just continue to widen indefinitely?
That is the pivotal question for the next earnings cycle. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.